Welcome to the Opening Bell Report.
90%. I want you to just, sit with that number for a second. 90%.
In a single trading session.
Right. In one day, if you walked into your boss's office and asked for a 90% raise, they'd laugh you out of the building.
Oh, for sure.
If you went to the gym and tried to lift 90% more weight than yesterday, you'd probably end up in the hospital. But in the stock market, specifically looking at Friday, February 6, 2026, that number is very, very real. And it belongs to a company called SMX, Security Matters PLC.
Yeah, and it wasn't just a gain. A 90% move in, like a blue chip stock, is impossible. What we saw on that Friday, it wasn't a gentle upward trend. It wasn't a good earnings report. It was violence.
Right.
The analysis report we're looking at today calls it a vertical re-rating, which is a very polite, almost sterile way of saying the stock chart looks like a rocket launch.
Or a glitch in the matrix.
It does look like a glitch, but it's not. It's a very specific, very aggressive market phenomenon.
Welcome back to the deep dive. Today, we are putting aside the boring index funds and, the buy and hold for 30 years advice. We have a specific document in front of us today, an analysis report titled the SMX Liquidity Squeeze and Market Volatility Report. And the mission is pretty simple. We want to figure out if this is the next massive short squeeze. We're talking about a stock that exploded, and we need to understand the anatomy of that explosion.
And I want to be the voice of reason right off the top here.
Yeah.
We are not giving stock tips. We aren't telling you to go mortgage your house and buy SMX. Please don't do that.
They do not do that.
What we are doing is dissecting a car crash in slow motion to see how the engine failed. Or, in this case, how the engine suddenly went supersonic.
Because when a company that everyone thinks is on the brink of disaster, I mean literally knocking on death's door, suddenly doubles in value, there is a fascinating story there. We're going to talk about traps. We're going to talk about something called death spiral and millions of shares changing hands in the blink of an eye.
It's the classic case study of market mechanics, completely divorcing from business fundamentals. It's not about how many widgets they sold. It's about math and panic.
So let's unpack this. Take us back to the scene of the crime, Friday, February 6th. What actually happened on the tape?
If you were watching the ticker for SMX, you saw something that, well, it just shouldn't happen. The stock opened the day at $8.60.
Okay.
Now, usually a volatile day might see a stock move $1, maybe $2. SMX didn't do that. It closed at $15.83.
That is the nearly 90% jump, but it actually went higher, didn't it?
It did. The intraday high hit $20.50. So at one point, if you had bought at the open, you were up well over 100% by lunchtime.
Wow. But here is the thing that jumped out at me in the report. It wasn't just the price moving, it was the volume. The sheer number of shares just flying back and forth.
The volume anomaly. This is actually more important than the price. The report notes that SMX traded approximately 39 million shares that day.
39 million. To the average person, that just sounds like a lot. Like saying a billion stars versus a trillion stars. It's just a big number. Put that in context for us. Why is 39 million such a shocking number for this specific company?
It's shocking because the float is the number of shares actually available for the public to trade shares that aren't locked up by insiders or restricted.
Got it.
And because of some corporate maneuvering we'll get into, specifically reverse stock splits, SMX has a very, very small float. So trading 39 million shares doesn't just mean a lot of activity. It means the entire company turned over multiple times.
Wait, hold on. So that means every available share was bought and sold, then bought and sold again and again all in one day.
Precisely. Imagine a game of musical chairs. You have 10 chairs, but you have 1,000 people trying to sit in them, and the music stops every 3 seconds. That is the level of turn we are talking about.
Okay, I see.
The report calls this volume turnover, the hallmark signature of a liquidity squeeze. It implies the same shares are being frantically passed back and forth because there simply aren't enough to satisfy the demand.
Okay, so we have the what? A massive price explosion in volume that looks like a typo. Now we need the why. Why did everyone suddenly decide they needed to own SMX on Friday? Was it record profits? Did they cure a disease?
No. And this is where you have to separate the story from the mechanics. It wasn't about profits. It was about a trap. To understand this rally, you have to get inside the head of the people betting against the company.
The short sellers.
The short sellers. These are traders who borrow stock and sell it, hoping the price crashes so they can buy it back cheaper and keep the difference.
Right.
And prior to this news, the thesis, the reason people were shorting SMX was pretty solid. They believed SMX was running out of cash. They were betting the stock would go to zero or that the company would face bankruptcy.
So they're sitting there, confident. They think the patient is terminal. They're just waiting for the flat line. And then the news drops.
The catalyst. SMX announced an amendment to their equity line of credit, or ELOC.
Okay, let's break that down because Equity line of credit sounds like typical corporate jargon. What does that actually mean for the company?
In the simplest terms, they secured a credit facility of up to $250 million. The report says this extends their capital runway into 2028.
So yesterday, the shorts thought the company was going broke next week. Today, the company says, actually, we have access to $250 million and we're good for the next 2 years.
Exactly. The bankruptcy thesis didn't just bend, it was incinerated. If you are a short seller, your worst nightmare is a company that you thought was dying suddenly getting a massive injection of life support.
Because if you're short, you need the price to go down to make money. If the company is guaranteed to survive, the price isn't going to zero.
Well, it's worse than that. It's not just that you won't make money. It's that you have unlimited downside risk. If you buy a stock, the worst that happens is it goes to zero. You lose what you put in. But if you short a stock and it goes to $100 or $1,000, your losses are theoretically infinite.
That sounds terrifying.
It is. So when this news hit, the shorts realized they were on the wrong side of a trade that could wipe them out. They didn't just want to get out, they had to get out.
And to get out of a short position, you have to buy the stock back.
You have to buy. And when everyone who is short tries to buy at the exact same time, on a day with positive news, where regular buyers are also stepping in.
It adds rocket fuel to the fire. You have the people who genuinely like the news buying, plus the people who hate the news but are forced to buy to save their skins.
That is the definition of a short squeeze. It's a panic buy.
The report calls this the fuel, and it identifies 3 specific pillars that made this explosion possible. We touched on the news, but the report lists microfloat, high short interest, and cost to borrow. Let's dig into that first one, the microfloat. You mentioned this earlier, but I want to understand how a company gets a float that small.
This is critical context. SMX didn't start with a microfloat. They created it. The report details a history of what it calls relentless reverse stock splits.
I saw the ratios in the report, 1 for 8, and then this one really stood out to me, a 91 for 1,000 split. That sounds like someone just mashed the keypad.
It does look arbitrary, doesn't it? 91 for 1,000. But think about what that signals. Companies usually do reverse splits because their stock prices crash below $1. ASDQ has rules.
Yeah.
If you stay under $1 for too long, they kick you off the exchange. So the company combines shares to artificially boost the price.
So if I have 1,000 shares at 10 cents, suddenly I have, 91 shares at about $1?
Roughly, yes. The value of your holding doesn't change, but the number of shares shrinks dramatically. When you do this over and over again, like SMX has, you just evaporate the supply of shares. You shrink the float down to a tiny, tiny amount.
So going back to your chair analogy, we don't have 1,000 shares anymore. We have 3 chairs.
Exactly. And that scarcity creates volatility. It doesn't take much buying pressure to move the price when there's so few shares to go around. A small order can jump the price 50 cents. A big order can jump at $5.
Then you add pillar number 2, high short interest.
The report notes that previous data showed short interest in the triple digits. That means, at times, there were more shares sold short than actually existed in the float.
Which seems mathematically impossible, but it happens in these weird market corners.
It happens because shares are lent out, sold, lent out again, and sold again. It creates a synthetic supply. But even if the short interest had come down a bit, the report says any double-digit short interest on a microfloat is a powder keg.
A powder keg?
You have a tiny room, the float crowded with people holding gasoline, the shorts.
And then the spark is the third pillar, cost to borrow. I feel like this is a metric people ignore, but the report really emphasizes it.
Think of cost to borrow like the interest rate on a loan. If you short a stock, you are borrowing someone else's property. You have to rent on it.
Okay, so like renting a car.
Exactly. Imagine you rented a Toyota Camry to drive for a week. The rate is $30 a day. Fine. But suddenly, the rental company calls you and says, hey, everyone wants Camrys right now. The daily rate is now $500.
I return the car immediately.
You would have to.
Yeah.
And that's what happens here. As the price rips 90% higher and the shares become harder to find, the interest rate to hold that short position skyrockets. It becomes incredibly expensive just to hold the position overnight.
So the shorts are losing money on the price going up, and D, they are paying a fortune in interest just to keep losing money.
It forces a decision. You can't just wait it out because the cost of waiting is eating you alive. You have to close. You have to buy.
Right.
And that buying pushes the price up further, which makes the cost to borrow go up further.
And round we go, the feedback loop.
Right.
So we have the setup, we have the explosion. Now let's look at the chart itself. The report does some technical analysis here that I think is really useful for visualizing this. They talk about breaking resistance at $10.
The psychological hurdle. In trading, round numbers often act as mental barriers. $10 is a big one. When SMX smashed through 10, it signaled that the bulls were in complete control. But the report highlights something even more important, the gap.
Right. The stock closed previously at 8.35 and then shot up to nearly 16. It just jumped over everything in between.
A gap creates what the report calls a vacuum zone.
A vacuum zone. Explain that. Why is empty space on a chart dangerous?
Think about building a staircase. If you build every step, you can walk up and you can walk down. But if you build step 1 and then jump straight to step 10, there are no steps in between.
So if you fall from step 10,
You don't hit step 9, you hit step 1. That's the danger of a gap up. Because no volume traded between $8 and $15. There are no bag holders or buyers at $12 waiting to defend that price. It's an air pocket.
wow,
If gravity takes over, you don't slide down a hill, you fall down an elevator shaft.
that is a terrifying visual. So the report gives us 2 critical numbers to watch now to see if we fall down that shaft or keep climbing. The ceiling and the floor. Let's start with the ceiling.
The key resistance level is $20.50. That was the intraday high on Friday. The report suggests that if the stock breaks that 2050 level, it could trigger a new wave of algorithmic buying.
Machines seeing the breakout and automatically jumping in.
Exactly. The algorithms don't care about the ELOC or the business model. They scan for momentum. Breaking the high of the day is a massive BUY signal for a robot.
And the floor.
The support level is $12. The report is very firm on this. The stock must hold $12 to maintain the squeeze structure. If it drops below that, it enters that vacuum zone we just talked about.
Okay, so if you are watching this, 2050 is your green light and $12 is your trap door. But I want to pivot to the part of the report that really confused me at first. It calls this a death spiral warning.
This is the most important part. If you tune out everything else, listen to this.
Because on one hand, we have this amazing news. 250 million. Company saved. Stock up 90%. But the report basically says, watch out, this might actually kill the stock in the long run. How can getting $250 million be a bad thing?
It's not that getting money is bad. It's how they are getting it. We have to look at the terms of an equity line of credit.
Okay, lay it on me. What's the catch?
An ELOC isn't a loan like a mortgage where you just pay interest. It's an agreement to sell stock. When SMX needs cash, they print new shares and sell them to the financier, usually at a discount to the market price.
So they are creating new shares out of thin air?
Yes, dilution. But here's the death spiral mechanic. The financier who buys those shares, they usually aren't looking to hold them for 10 years. They want their cash back. So they sell those shares into the market immediately.
So every time the company raises cash, a wave of selling hits the stock.
Exactly. And what does selling do? It drives the price down. So the next time the company needs cash, the stock price is lower, which means they have to print more shares to raise the same amount of money.
Which creates more selling, which drives the price down further.
Which requires even more shares next time. It's a vicious cycle. That's why they call it a death spiral. The company stays alive, they have cash to pay the electric bill, but the stock price gets ground into dust because the supply of shares explodes.
It's like paying your credit card bill by opening another credit card with a higher interest rate. You feel relief for a month, but the math is coming for you.
That's a great analogy. It's a sugar high. The news of the 250 million gave the market a sugar high. Yay, we aren't bankrupt. But the crash comes when the dilution actually starts hitting the market.
So this creates a massive conflict for a trader right now. I want to play devil's advocate here. If I'm looking at this chart, I see momentum, I see shorts trapped, I see a rocket ship. Why should I care about dilution that might happen 6 months from now?
That's the bull case. The bull says, the squeeze is happening now. The shorts are forced to buy now. The dilution hasn't started yet. You can ride the wave up to 2030, maybe more, before the reality sets in.
But the bear case.
The bear says, this is a trap. The higher the price goes, the more incentive the company has to dump shares into the market to raise cash. The bear says that 1583 is a gift, and you should be selling, not buying, because the supply flood is coming.
The report seems to side with the idea that this is a technical trade, not a fundamental investment.
Explicitly, it says, do not marry this stock. This is not a stock you put in your retirement account and forget about. The price rise is based on market mechanics. Supply and demand imbalances, trap shorts, low float. It is not rising because the business suddenly became 90% more profitable.
I think that's such a crucial distinction. You can make money on a technical trade, but if you treat it like a long-term investment, you're going to get crushed by the mechanics of that financing deal.
History is littered with companies that had massive squeezes and then slowly drifted to zero because of toxic financing.
So let's wrap this up with the verdict from the report. It asks the question, is this the next big squeeze? What's the final answer?
The report gives a definitive yes.
A straight yes? No hedging?
Well, yes, with an asterisk.
Yeah.
It says the conditions are perfect. You have the low float, you have the high volume, you have the survival news, and you have the trapped shorts. It's the perfect storm for a price explosion.
But the asterisk is the volatility.
Right. It warns, expect violence.
Yeah.
These things go up fast, and they come down just as fast. If you're going to play in this sandbox, you need to know where the exits are.
Speaking of exits, let's recap the actionable watch list from the report one last time.
Okay, write these down. The bullish trigger, the point where the squeeze potentially expands, is a break above $20.50. If it clears that, look out above.
And the get out signal.
The stop loss is a close below $12. The report suggests that below 12, the squeeze structure is breaking, and you're likely falling into that vacuum zone we talked about.
And volume.
Keep an eye on that 39 million number. The report says as long as daily volume remains above 10 million shares, the squeeze is active. If volume dries up, if it drops to 1 or 2 million, the party is over.
It really is a fascinating glimpse into how fragile and explosive the market can be.
Yeah.
You have this tiny company, SMX, that gets caught in this whirlwind of math, psychology, and toxic finance.
It is psychology. That's really what a short squeeze is. It's panic, it's greed, it's fear, all playing out in real time on a ticker tape. The fundamentals of the company, what they actually do, almost don't matter in the short term.
And that raises a really interesting question for me to leave our listeners with. We spend so much time trying to value companies, looking at their PE ratios, their revenue, their products. But when you see something like SMX explode 90% in a day because of market mechanics, it makes you wonder.
Dude.
In a market that is increasingly driven by algorithms and liquidity squeezes and high-frequency trading, at what point does the price of a stock completely detach from the value of the company?
That's the billion-dollar question.
And can you spot the moment gravity takes over again?
Usually only after it's too late.
Well, on that cheerful note, that's our deep dive on the SMX short squeeze, a fascinating anatomy of a market explosion. Whether you're trading it or just watching from the sidelines with a bucket of popcorn, it's definitely a show worth paying attention.
Don't forget to like, share, and subscribe for more.